Okay, we are going to get started here in just a few minutes. A couple of housekeeping items. This call is going to be recorded, and all in attendance will be able to receive an RCH credit if they participate in the chat. So if you hover on your screen where you have the Zoom application open, there will be at the bottom of your screen the option to open up the chat box. So if you go ahead and open that up, you can send us in questions, and you can also answer our questions throughout the presentation to prove your participation for those RCH credits. Because this is being hosted by the Western Region Payroll Association, every month we offer these educational meetings. We have spectacular guests who come and join us. And the whole goal is to help us stay up on recent changes or review important information to do with payroll, HR, benefits, everything that we deal with on a regular basis. So anyone who's interested in joining and becoming a regular member of these meetings, we will send out a registration form that you can get back to me if you're interested in joining. Today, we are lucky enough to have Steve Hovland with us, and he actually is a principal at Hovland Forensic and Financial. We'll be presenting on the topic of, sorry, I'm trying to multitask here, the topic of a segregation of duties in regards to employer fraud awareness and just financial fraud in general. So Steve is a certified public accountant and a certified forensic accountant, and after 20 years in public accounting, he realized that the old model for doing things in accounting really no longer worked and no longer benefited his clients. So he came up and started implementing a virtual CFO and a fractional CFO program, which allows employers to work with Steve to understand their current financial situation and really map out a plan for the future. Angela's actually known Steve since her college days, and we're very lucky to have that connection and have Steve's expertise and his time with us today. So thank you so much for joining us. I am going to pass it over to you, Steve. Do you want to share your screen?
Sure.
Okay, I'm going to stop my share. Steve can take over.
Okay, thank you. Give me 1 second to get my screen to share.
Thank you.
Okay, are you seeing my screen? Because I
Yes.
Okay, good. Sorry, my video is not working yet, so I truly do have a video camera for everybody. For some reason, every time I click on it, it says video failed. So apparently it doesn't want me to be seen as I do this presentation. So as Manna said, my name is Steve Hovland. I'm a CPA and a certified forensic accountant. And I spent 20 plus years at a mid-sized firm here in the Grand Junction area and with another firm up in the Fort Collins area. And then after that, I ended up, hey man, I keep getting the dings on my side for people requesting access. Is there a way to mute that?
Let me see if I can turn that off.
Okay. So while she does that, so long story short, I ended up starting up my own firm back in May, June of 2019. And we service both virtual CFO clients. Again, that's no different than what a lot of you have experienced during the pandemic. Was able to access accounting records and help companies, determine their cash flows, resources that they need, so on and so forth. Then the other side of my business is forensic accounting. And I got into forensic accounting approximately 10 to 12 years ago because I really enjoyed analyzing internal controls for companies. And from there, I ended up becoming a forensic accountant. And on that side of my firm, I go through and I do investigations primarily through being hired by attorneys investigating financial statement fraud. So when I started going through that process, I realized that the main weaknesses that usually cause fraud are lack of segregation of duties. That is the primary reason why when you have financial or monetary fraud, i.e. embezzlement, it's usually because there is a lack of segregation of duties. And so because of that, what I wanted to do is put together a presentation. And this presentation is actually one that I present to the business incubator at their Leading Edge class. So if any of you have been through the Leading Edge, this is actually the presentation I do. But I feel it's a very valuable presentation for those individuals who are not up to speed on internal controls as to what to look for and honestly how to prevent fraud taking place. So as I said, this presentation is segregation of duties, and I believe, Manna, you if you want, you can send out a copy of this presentation to everybody if they so choose. And again, my firm is Home Forensic and Financial. So, excuse me. What we'll cover is the 4 main areas of proper segregation of duties. And while there are 4 areas, a lot of small businesses have a hard time making sure they have controls over every 4 areas. So we'll also talk about some of the mitigating factors that help mitigate or prevent fraud, even if you don't necessarily have access to the resources to mitigate every single area. And of course, we'll talk about the mitigating controls. And we also will talk about some of the common weaknesses. And in this example, we'll go through cash disbursement cycle. Now, the 2 main cycles are cash disbursement and cash receipts. But cash disbursement is usually the easiest way for somebody to steal money from a small business or really any business. So first thing, if you ever get a chance, and you can also do it during this presentation, I suggest going into Google and typing in bookkeeper fraud. You'd be amazed on how many hits you will have when you type that in. And periodically I'll go in and do that once a month, and they will change consistently. This screenshot was from approximately 1.5 years ago. But as you can see, all I did for the screenshot was I just typed in bookkeeper fraud and bang, I already have all these hits that come through. And the reason why I have that in there is just want people to understand that when fraud happens, it's not always going to be somebody who has a master's degree in accounting or a doctorate degree in accounting. It happens across the board. And in this case, these are the bookkeepers who traditionally just do data input for a small business, and you're seeing 2.4 million, 1 million, $5 million in fraud and theft, and pretty much every one of these happened because there was lack of segregation of duties at the companies. And in one case in particular, that Hampstead bookkeeper, I'm actually going to walk through that article and show you, after we go through the segregation duties, show you where all the breakdowns were within that organization, and how it could have been prevented. So first question, or first area, is the 4 main areas of segregation of duties. The first area is authorization. Now, authorization is just like what you see. Who can authorize the purchase of inventory, equipment, supplies, etc. Also, authorization is also considered to be signing of checks. So if somebody signs a check, they are authorizing that payment. And the reason why I bring that up is I actually had a situation where doing a presentation, I was testifying in court, and the individual who had committed the embezzlement had signed a bunch of checks, and the opposing counsel had said, well, John Doe did not authorize these payments, and then I literally brought up the picture of the check, said, well, his signature's on there. So signing of a check is technically authorization in that process. The next area is recording. Who records the transaction? Again, that's kind of a black and white. Who's doing the accounting for their organization? Physical custody. Now, in the quote olden days, physical custody was literally who had access to the checkbook. But now today's day, Physical custody usually revolves around who has access to the bank account, who has access to the wiring of the funds, goes into the online account and can adjust anything. And also physical inventory. Right now, if you're trying to buy physical silver, the market for that is very sparse, and those particular areas that have actual precious metals, they have specific controls over the physical inventory, because obviously it's a valuable asset. So physical custody is the third area. Now, the most important area is monitoring. Who monitors and reviews the bank recs, bank statements, subsidiary ledgers, controls, budget, actual account fluctuations, etc. Now, of all these areas, monitoring is the most important area. And you'll see when we cover those frauds that we showed briefly on the bookkeepers, is lack of monitoring, or the lack of monitoring really caused a lot of these frauds to happen. And so as a small business owner, or even as if you're working for a business, you want to make sure the monitoring function is being handled by somebody who is not necessarily doing the other areas. And the recipe to have embezzlement fraud happen to an organization is to allow one person to have access to every single one of these areas. The second you do that, you might as well have just handed over the checkbook and the credit card to that individual, because they have free reign on the company and they can hide pretty much anything. Well, I say hide. Some of us can find it, but it's after the fact. But for the most part, one individual should never have access to all three of these areas. So first question that I wanted to throw out there for you guys to get your credit on is, within the segregation of duties, which one is the most important for the control aspect? And I'll let you handle that on the chat area. So I want to walk through a general example, and to go back on the 4 areas of segregation of duties. In the textbooks that you see in college, they talk about these 4 areas, and they want one person to be responsible for every single area. Now that would be the most ideal situation, bar none, because you would have to have collusion of 4 people to be able to instigate fraud. But in reality, most businesses are not going to hire 4 separate people to cover all these areas, plus have their own duties. You would have to be a fairly large corporation to have people pretty much in each of these areas, to be able to have those controls over more or less the financial records. And I know personally, I've seen companies that make 10+ million that don't necessarily have one person for each of these specific areas. So just want to kind of throw that out there, that the most ideal way is to have one separate person over every area. But in reality, that doesn't always happen, because it's too cost prohibitive in that aspect. So real quickly, I just want to kind of give an example as to how this gets broken down. And again, you guys will have access to the presentation. You read through it, so I'll go through this kind of quickly. But I wanted to kind of give everybody an idea as to how this process works. So hypothetical example of a chocolate company. You have one person, Jane. She orders 15 pounds of dark chocolate for $55. So she's authorizing the purchase. John, receiver, gets the package of chocolate in, receives it, checks the packing slip, and verifies that 15 pounds that was ordered, agrees that what was actually brought in, sends that information to Stacy, who then inputs the information into the receiving. Then Jane comes back and approves everything, because she verifies that that was what I shipped. This is what we got. So yes, that is approved to go ahead and be paid. The controller comes in, Dennis controller goes through and reviews the invoice, and then he manually signs the check, and returns the invoice, that is marked paid, to Stacy, and he gives the check to Donna, the administrator, to mail out. Then later on, Bob, the CFO, reviews the bank reconciliation, initials and dates his approval on the bank rec. So in this whole process, you have different people at different levels, within the financial cycle. In this particular instance, this is the disbursement cycle. And these individuals are covering, they're performing their function. And so the odds of having a theft of resources is very, very low unless you have pollution. So, but again, like I mentioned before, this is going to be cost prohibitive for most companies that are probably, my gut says, less than 40, 50 million in revenues. Now, to combat this process is there are mitigating controls you can have in place. Like I said, you never want to have one person responsible for all 4 areas, but you can break them up so that most likely there's going to be 2 people in the office, and you'll be able to break it up and identify, okay, person A is going to do this and person B is going to do this. So in this situation, and this is what you traditionally see for the smaller businesses up to about, I'd say about 1 to 2 million in revenues, is you're going to have one person, a bookkeeper / accountant, will do a lot of the data entry, a lot of the accounting processes. And then you're going to have the owner, manager, president, CEO, whomever will do the other side. And as you can see within this, how it gets broken up is on the owner side, they sign checks. That there's the authorization aspect. So they're controlling the authorization part of the 4 functions. They're reviewing, or they perform the interbank transfer. So they have control, custody over the assets on that aspect. And the biggest item, and again, this goes back to the most important to control, is they're reviewing the bank reconciliations. Now, that is probably the single biggest key within the monitoring function. Yes, you want to make sure you monitor budget to actual, assuming the company actually did a budget. But of all the monitoring functions, reviewing the bank reconciliation is probably the biggest key in the control process. So for instance, when I do a forensic investigation, and if it's on a company that believes they've had embezzlement, theft, one of the first areas I go to is one, to see if they did a bank rec. 9 times out of 10, they didn't, because otherwise they probably would have had the theft. But the bank rec, once you're comfortable with the GL reconciles back to the bank statement, you know that all the transactions are in the bank records. Now it's just a matter of figuring out, was it put in the proper place, or was there theft of those items that I can identify? But reviewing the bank rec a lot of times will catch errors, fraud, on the, almost not immediately, but by month end. And so within all the monitoring functions, yes, there's quite a few, but the bank rec, review of that bank rec is always the biggest key in there. And so mitigating controls for 3 persons. Again, now you start breaking it out to even more processes. And again, a lot of this, when you start getting a 3-person firm, you start taking a lot of some of the monitoring and some of the custody parts, and you're putting it into a 3rd person. And so this is probably, outside of the 4-person, is probably the most ideal situation. Again, when you get to this level, you're probably looking at anywhere from 5 to probably 20 million in revenues for the company, because they're large enough. They need to have, an accountant and somebody to manage a lot of the processes, and then the CEO. So again, I won't go too much into this, but again, as you can see, the owner / CEO, they're still doing the monitoring function, even though the office manager does some of the information or goes through that process. The monitoring function has not left the owner. And as I go through this, if anybody has questions, just feel free to speak up. Again, it doesn't bother me if I need to stop, but if you do have a question or concern that you've come across, please feel free to jump in at any time. So to kind of bring this into kind of real world terms, again, we kind of went through the 4 areas, and a lot of this is very textbook type information. But to bring this into real world terms, I wanted to kind of go through common weaknesses that I've seen in my career, both as a former audit partner and as a forensic accountant, and kind of walk through what the weaknesses is and what was the main concern within those weaknesses. Now, as we discussed just a second ago, bank reconciliation is very key on a monitoring function. Now, a common weakness that I've seen is a bank rec, one, is not prepared, or two, is not prepared timely. Now, the timely basis is very, very important because when you have errors, and I'm sure everybody's came across this where you did the bank rec and, it turned out it was an error because somebody had put a debit in as a credit, or they had forwarded a check or what have you, and it causes you to be, off by quite a bit. A bank rec, if it's not prepared timely, then a lot of the errors, misappropriations, i.e. theft, may go undetected and may grow larger over time. Case in point, I had an instance happen several years ago where I was performing an audit of a company, and it was the first time they've ever had an audit, and the particular accountant did not want to give us the bank reconciliation, or she continuously drug her feet. Finally got the bank rec from her, and this was like 3 or 4 months after, or not 3 or 4 weeks after the audit had started, and we finally got the bank rec. And when we look at it, we realized there was literally, it said unexplained difference in there. And as most of you know, bank recs really shouldn't have an unexplained difference. Maybe a couple cents here and there, but not a big one. Well, there was a difference in there, and as we started pulling that thread, we came to discover that she had been stealing from the company for the past 20 years. And of course, the management had not been reviewing the bank recs. They hadn't been monitoring much of anything in there. And so, but because she had not been producing bank recs and they weren't produced timely, management was not aware of the theft that had been going on. And of course, bank reconciliation not being reviewed. Now, this is the other aspect: is bank recs are getting done, but then nobody's reviewing it. So it kind of defeats the purpose of, yes, the bank rec is done, but you need to have that monitoring function. Somebody needs to review it. Even if you have to pull teeth to get that owner, whoever, to review it, they need to review and preferably sign off so you can identify they reviewed it. But they need to actually review it, saying, yes, so and so already did the bank rec, I don't need to worry about it. Well, it needs to be reviewed. Again, that's a critical step in the monitoring function. Checks are given back to the accounts payable accountant for mailing. This way you don't see as much anymore, given it as much electronic checks that are going out. But this is a weakness, because if you think about it, if you have a control in process where the accounts payable clerk input the information in the accounting records, they cut the check, they give the check to the owner to sign, the owner signs it and gives it back to them. Well, now they can manipulate either the check or where it goes. I mail it to themselves at a different address, and then they have access to the record. So we've always said, after a check is physically signed, it should go back to somebody who's not a part of that process. A lot of times it's a receptionist, have them physically mail it out, or if there's only a few, the owner can sign and physically stick it into the envelope and send it into the mail. So that's always been one of those areas that it's not as prevalent anymore, but it still is considered a common weakness. Now, signature stamp. This one is one of my personal bugaboos, because I know of an organization that still uses one, and I'm literally talking a physical stamp, with the little ink pad, and they stamp the signature onto the checks. You do not want to have a signature stamp, because if you have a signature stamp on your company, you give it to an individual to go ahead and sign checks, you just gave that individual signing authority on your company, even though they're just physically stamping a signature. That is what is happening in that process. So as just my own personal recommendation is never have a signature stamp. A lot of times, the only company that would need any kind of sort of quote stamp is some of your larger corporations, like locally, like HMO or CMU, you know, large organizations that has lots of checks going on. And even then, they have either a signature plate, or they actually have the electronic signature under controls. But when you have a signature stamp, a physical stamp, there has to be a set of controls all around that stamp itself. So again, never have a signature stamp, because again, that's signing authority on the company. And if somebody were to commit fraud, you would have a hard time going after the bank, because they would have experience of seeing that stamp being used on a check. So stale checks. This is a weakness mainly from the standpoint is, as many of you who've done bank recs know, the longer a stale check shows up there, the more time you have to spend on that check or that list of checks every single month. And so a lot of times what we recommend is, if you get checks, you know, past the 90 days or so, you know, constantly contact that vendor, possibly reissue the checks. But then the other aspect is there is the escheatment requirements with the state of Colorado. So all those come into effect, but really from more of an efficiency standpoint is to stay on top of the stale checks and make sure they're getting, you know, kind of dispersed or quote cleared out in a timely manner. Vendor setup. Ideally, new vendors should only be entered by somebody outside accounts payable. Now, I know that's, you know, if you have a two-person company, that's not going to happen, and I fully understand that. But the accounts payable person having the ability to set up a new vendor is really no different than if you have somebody who's doing payroll and they have the ability to set up a new employee. It's really the same concept from a control standpoint. If you have a situation where somebody is in accounts payable and they have the ability to set up a new vendor, then at a minimum, that vendor list should be reviewed by somebody outside of that function. Again, the reason why you do that is you want to make sure a fictitious vendor does not get set up. Because if you have somebody who's committing fraud from the AP side, they're going to set up a new vendor. And the example I always give is, you know, a known company here in town is Elam Construction. If the company you work for does, you know, has Elam come out and do a lot of paving for you, they could theoretically set up a fake vendor and put like an S at the end of Elam instead of Elam. It says Elams, and most people might not even catch it. You know, they might sign a check, say, "Oh, here's an invoice for this fake vendor," because it's just spelled just a little bit different, and it could easily go out the door. And so that's why, you know, if you don't have the ability to have somebody control who sets up the vendor, then make sure that at minimum the vendor list is being reviewed to make sure there's no fictitious vendors on there. Conversely, a fraud that does actually happen to companies from the outside. Now, this is an internal fraud that would happen, but a fraud that can happen from the outside is you have somebody who sent your company an invoice, you know, say 3 years ago, and you haven't done business with them, but you haven't terminated them as a vendor in the system. There has been documented fraud where those companies have sent out an invoice to a company, usually a larger company, and to see if that company will pay the invoice. You know, even though they didn't provide any services or anything, they'll send an invoice just to see if the company will pay it. And if that AP person goes in, they see, oh, there's still an active vendor with us, they may not think twice about it. So that is a fraud that happens externally. There was actually a fairly famous one that happened, I want to say about a year and a half, 2 years ago, where individual had sent invoices to, it was either Amazon or Facebook, one of the very, very large companies, and we're talking millions of dollars. And of course, a company that size probably didn't blink an eye at it, but it was still an external fraud that there was no actual service that was ever provided to this organization. So again, common weaknesses, vendor setup. If you can't exclude the person from AP setting it up, then the list needs to be reviewed periodically. Now, Payroll. This first recommendation is kind of an older one, and many of you, especially with Angela's company, that's probably not necessarily applicable anymore. But if employees who receive physical checks, and there are still companies out there that actually still do issue physical checks for payroll, need to make sure that the payroll is either coming from an in-press account, or I don't have it listed here, or you have a positive pay account set up for the paychecks. Now, for those of you who are not familiar with in-press account, that's the old zero balance or $1 balance account, where the concept is you do transfers for payroll from your operating account into the in-press account, and it's just for the total amount of payroll. So if the total amount of payroll is $50,000 for all the employees for the pay cycle, you would only transfer $50,000 out of operating into the in-press account, and that's a manual transfer. You transfer it over that account. If somebody were to manipulate a physical check, that particular, eventually one of the checks or transactions would bounce, and it would red flag, and you'd be notified by the bank that there was a check that had bounced. Again, because it would go below the total amount that got transferred. The reason why you want to do a manual transfer is you don't, if somebody were to manipulate a check, say their paycheck was $1,000 and they manipulated it to $10,000. If you just have an automatic link between the operating account and the in-press account, you pretty much defeat the entire purpose of the in-press account. And so if that in-press account goes below zero, the bank is just going to go to your operating account and pull the funds to cover that particular check. So that's why if you don't have positive pay set up, or you don't have a trust account set up, through like a payroll service, you want to make sure that your operating account, your in-press account aren't linked, and you're using that in-press account properly. And again, this is just to protect, from somebody, manipulating their paycheck. Another aspect that I don't have in this actual presentation is the ability of the payroll, individual covering payroll, and the HR function. Now, as many of you probably know, that person who enters the hourly pay rates of the employees should not have the ability to adjust pay rates, or the individual, let me phrase that, the individual who's entering the hours of the employees should not be able to adjust the pay rate of the employees. So in other words, that's why you have an HR function. When an individual has the ability to both input hours and pay rates, you have the susceptibility of either bumping up an employee's paycheck right before payroll and then reducing it back to the normal amount after payroll, or conversely, what many of you have heard about, the ghost employee. They have the ability to set up a ghost employee. They can input the rate, they can input the hours, and if you have the ability and the rate, a lot of times you have the ability to input all of the other information, such as address, withholding, so on and so forth. So the ability to input hours and the ability to input pay rates should never be the same person. Again, if you're a super small organization and you can't split that function up, or you don't use an outside payroll service, then at a minimum, the payroll register should be reviewed by somebody outside of who process pay, the payroll, to verify that all the pay rates, at least the pay rates, are consistent with what they should be. Second question is, we just kind of went over it. Should an individual have the ability to input hours and pay rate for employees? So next area, and this one may seem a little odd, but there's a reason for it. On voided checks, you want to make sure you deface those voided checks. The reason being, and by defacing, what I suggest is, yes, you can write void on it, But the easier way is to rip the microcoating off the bottom, just quick rip that thing off. The reason being is I've seen several times in some of my investigations where an actual check has been cashed that either one wasn't made out to anybody, the payee was literally blank, or two, there was no signature on the actual check. And so it kind of boggled my mind. And what I have written here in red, institutions will look at checks below $1,000. That's probably even too low nowadays. But like I said, I've seen that before where those checks had gone through that weren't even signed or made out to any individual. Luckily, they were legitimate checks, but it was just eye-opening. And this was way back when I was a staff accountant, that the check could be processed like that. But that is why you want to deface the voided checks. And also, you want to consider having a policy for your company as to how long do you want to maintain those voided checks. Usually what I've seen is a lot of times they will keep it for a year, just to make sure that everybody's comfortable. Yes, that was a void check. I can see it physically voided. It's been defaced. It's been a year. Okay, now let's shred those. Again, that's on a company by company basis. There is no set process in that. And then expense reimbursement. Now, expense reimbursements should be reviewed by obviously another individual of the organization prior to being approved for reimbursement. And the review should entail both looking at the invoices, verifying, yes, there truly was an expense, but also there should be some sort of form, either a paper form, or if you use file.com or expensify.com, which are more electronic based expense reimbursement type platforms, it needs to have some sort of indication as to what the purpose or what the business purpose of that expense was. Again, a lot of times, especially with not-for-profits, the easiest way to steal money is through the expense reimbursements. Either they pay for personal expenses, or they go through and they fill out their expense form, but they don't put all the receipts on there, or they just put random item on there. So that is the expense reimbursement form. Sorry. Now I want to show you that particular case. So if you remember earlier when I showed you the bookkeeper fraud, one of those stories was on that Hampstead bookkeeper. And again, this was pre-COVID. Unfortunately, I can't see the date, but I think it was February of 2020, where this particular bookkeeper had admitted to stealing close to $1 million from a family-run business. And what I highlighted here is the things to, when you do look at these frauds that are committed by bookkeepers, what are the telltales that there was no segregation of duties? And in this first area, that's her last name, she had used company checks to pay her own personal credit cards and her property tax bills, forged signatures, created fake bank statements as part of her scheme. So when you first see that, that immediately tells you that there was no monitoring going on. Because if you are the owner of the organization, one, if she had to forge signatures, you would have saw the forged signature. You would have identified that, especially if it's a family-owned business. They know who's signing those particular checks, creating fake bank statements. So that means that they're not reviewing, they being the owners, weren't reviewing the actual bank statements, because you probably would have identified the fake bank statements, because one, it would have looked odd, but two, you would have also probably caught that if you did a budget to actual that you consistently follow. Then the next part I highlighted here, where the son of the owner, he said that he does not think the sentencing was sufficient for what she did, is frustrated that there is a continuing disagreement on the exact amount of money stole. Now, the important thing to understand is when somebody is, I want to say, caught for committing embezzlement, they will never tell you the full extent of what they stole. I mean, they never will. They will only say up to the point that they think what you know. Usually what I've seen, and this is in it's called the Report to the Nation. It's a free report that's put out every 2 years by the Association of Certified Fraud Examiners. And in that report, they pretty much indicated that when a person who commits embezzlement identifies, yes?
Are we missing something that you're highlighting here? Because we're not seeing anything.
Are you not seeing my screen? Sorry.
We're just seeing common weaknesses.
Okay, give me 1 second. I was hoping that would have shared, but let's go. How about that?
There we go. That's
there
better.
we go. Sorry about that. So here's that first part that I was explaining that nobody could see. And again, this is on that Hampstead bookkeeper sentence to prison. Within this article, she had used the company checks to pay her own personal credit cards for property tax bills, forged signatures, so on and so forth. Down here, where we highlighted it, she had said that there's a disagreement on the exact amount of money she stole. Again, as I was saying, is most people who commit fraud will not indicate what they totally stole. And based on the study by the American Association of Certified Forensic Examiners, they say usually you can take whatever somebody says they stole and multiply it by about 8 to 10 times, and that probably gets to the true number. Because keep in mind, when these people commit fraud and they steal money, they don't admit to everything. Again, they're just trying to admit to what they think you stole. And so anytime they say, hey, I only stole $1,000, it's probably closer to $8,000 to $10,000, just on the kind of rule of thumb. Now, some of them may be actual honest by that point, but don't hold your breath on that. The other thing to highlight in here is obviously the dollar amount. She stole $900,000. That money right there, that came off of the bottom line of that company. That's their net income that they stole. If you figure out, if you have a company whose net income to sales is, let's just say 10%, that means you have to take that $900,000 and divide it by 10% to get the total number of sales you have to have above and beyond your normal sales just to recoup that $900,000. So that's an important thing to understand, is when somebody steals from an organization, they're stealing from the net income. They're not necessarily stealing from the sales line. And then another consistent one down there, the highlighted, she was employed by that family business for 17 years. Unfortunately, a lot of times the larger frauds happen because of the quote trusted employee. And again, it's, as a tax professor I had in college used to say, she was from the show me state. She was also the trust but verify type individual. So you can trust someone, but you've got to have the controls in place. You got to make sure that you have that proper segregation of duties in place. And then last item to highlight, in this article, they said a restitution hearing was, for the stolen funds was scheduled for April 30th and inspectors surrender on May 5th. Now, I haven't seen in the investigations that I have done anybody actually keep the money they stole. And so when you have a restitution hearing, the odds of this company ever recouping their amount are very slim. They may get pennies on the dollar and maybe half pennies on the dollar. But that's important to understand. It is, yes, they did the proper thing by pressing charges and making sure that this individual was tried criminally, but they're probably never going to recover this money. And again, if just simple segregation of duties had been in place, it probably would have prevented and or caught this scheme much earlier than what had happened. So with that, are there any I gotta make sure I get back to my proper. Sorry, give me 1 second, trying to go back and forth sometimes. Are there any other questions related to the presentation, either presentation or internal controls or fraud or anything of that nature?
I was wondering how this would translate as far as payroll would go. What other advice you would have for like smaller companies? Like I'm the only payroll person here. So if there's only one payroll, one HR person, how would I go about making certain that I have proper controls in my company?
For any kind of, for a small company like that, who do you run your own register, or do you use payroll register, or do you use an outside service?
I do everything. I don't have an outside service. I do everything in-house.
Okay.
So
from that standpoint is, if you're the one that approves the pay rates, then you want to make sure that you have a budget set up for your payroll, so that then you can compare actual payroll expense to budget, because that will trigger if somebody is manipulating the payroll. Obviously, they're going to take payroll, not give payroll. And so your payroll expenses will be higher than your budget, and then that will alert you to, hey, is this, are these amounts correct? Also, you want to periodically review the actual payroll register to see if there's any employees on there that you don't, or you can't identify. If you're the employee and the owner is the one overseeing everything, you want to make sure that the ownership is periodically signing off on the payroll register, so that then that covers you from an employee standpoint. It covers you on that aspect, that they are truly monitoring and they're able to identify any pay rate changes that should be on there.
okay.
Any other questions?
I don't see any questions entered through chat, but I do just want to say again, thank you so much for taking the time to speak with us today. I will definitely send out this PowerPoint and a recording afterwards, and I will also share your contact information. So if anybody wants to get in touch with you about a specific situation, they'll be able to do so.
Okay, well, it sounds great. And like she said, my contact's on there. And if you have any pressing questions or concerns, like you said, feel free to give me a call or shoot me an email.
Great, thank you, Steve. Now, for those of you who are interested in staying and listening to the presentation about the Colorado unemployment fraud and to get your RCH credit, I'm going to go ahead and take over this screen share and run through a few items in that regard. So are you seeing my screen now?
Yes, I am.
Yes.
Thank you. Okay. So a webinar hosted by the Grand Junction Chamber of Commerce with speakers from the Colorado Department of Labor was actually posted back in February, and it's a really excellent source of information to address this recent spike in Colorado unemployment fraud. And I'm going to do my best to summarize in about 10 minutes what they covered in an hour. In this presentation, and after we're finished here, I will definitely send out a direct link to that webinar, so you can take a look and listen to that if you're interested in learning more. Just a little bit of history. So the initial fraudulent attack was actually on the federal level, and it really started with that Pandemic Unemployment Assistance, or the PUA program, and really focused when the CARES Act extended benefits to 1099 non-employees for federal unemployment benefits. So that was the first target for this fraud. As that PUA program expired in December of 2020, so at the end of last year, the state fraud, that's when it spiked. So WRPA program ended, so the fraudsters shifted their focus to specific states. So Colorado Department of Labor, or CDLE as I'll refer to it quite often, has been charged with, since really the beginning of COVID, getting money to eligible individuals in need of that financial assistance as quickly as possible. So they're approving those requests immediately and then doing their research as to how and how much and why that unemployment wage is needed. And also due to the increase of weekly payments. So it was up to like an extra $600 a week for unemployment wages. And that really was an enticing scheme for a lot of these fraudsters. Just to give you an idea, in 2019, so year before COVID, there were 86 fraudulent claims in state unemployment. And then in 2020, there was over 800,000 that the state of Colorado was dealing with. So I don't even know what percent increase that was, but just an insane amount of fraudulent claims to state unemployment. And we know that there's truly fraud occurring here because our state unemployment rate has not fluctuated that significantly. So in March, our state eligible population that was employed was 64.1%. That compares to pre-COVID, that was 66.8%. So we did drop down to as low as 57% of our eligible population being employed in the midst of COVID, but our 64% is almost back up to that pre-COVID amount of basically 67%. So we just shouldn't be seeing this many unemployment claims. And a lot of people are looking at a finger to point, like who is to blame for this? The CDL wants to reassure everybody that this is not a data breach at the state level. It's typically not necessarily a data breach at previous employers or even payroll companies. What's really happened is basic identity theft. I mean, we all have at one point in time been a little bit careless with our information. And I'm sure that there's a spreadsheet somewhere out there that has more information on it about me than I would want anybody to have. So it's really just somebody storing up their identity theft, and they found a great outlet to use our information against it. We've even in our own office seen a fraudulent claim on a current employee. So almost everybody has been affected by it. And in fact, that's the question that I want to ask of all of you who are still on the call is, have you personally seen one of these fraudulent claims come across in your company? I know John, our president of development, he is at a conference today, and their response was 100% of the people at that conference have seen this fraud. And I'm curious to know if it's going to be 100% of all of us have seen some of this fraud in one form or another.
Madam, we actually had the president of our company, the former vice president, and several of our highest earners get hit with it.
Yeah, that was the same in our offices.
And that's the same that I've seen when our clients have called and said, hey, do we need to notify you? It has typically been the business owners or the highly paid individuals. And what I heard, I don't know if it's true or not, but in 2017, there was an Equifax data breach, and there's been a huge settlement. You can Google it and get some details. But I heard, I don't know if it's true, that that's where the majority of the data has come from, was that data breach in 2017. So there are the people who, facilitated that data breach, and they have all that information, what's called the black web, and it's available for purchase by other, fraudsters. So if you got a fraudulent claim like John got a fraudulent claim and he obviously still works here. We reported it as fraud. So going back to 2017, if we could trace it back to that data breach, his identity has been stolen for years. So it's always a good thing to go and take a look at your credit reports and keep on top of those for anybody. Thank you.
Thank you. So what's really happening right now at the state level is in prosecutions, prevention, and collection. And this has been taken over by a dedicated task force that was created to deal with all of this unemployment fraud. They've upped their analysis. So prior to COVID, they say that there were 5 fraudulent identifiers within the application for an individual applying for their unemployment. Now there's up to 50 identifiers, and that is growing. It's growing because fraudsters are adapting to what those identifiers are and could be. It was kind of interesting to hear questions about the identifiers at the state level, because they are being very hush-hush about it, and rightly so, because as soon as they start saying what those identifiers are, it's just going to give those fraudsters a fast pass through their analytics. So I wonder what they are. Another thing that the state is doing is trying to mitigate the harm that's done to an individual's credit and the effect on employers' premium rates. So we're obviously going to see an effect on those, but the state is doing all it can to control and mitigate that. And there's actually been a lot of federal funding backing up state unemployment. So that's where most of the payout funds have actually been coming from. And I just to talk about this slide a little bit, so that 19 million in fraudulent unemployment claims that have been paid out, they say that they've stopped, prevented over 400 million, because while they might initiate that first payment before really diving in and verifying employment information, that's where they're paying out that initial payment for state unemployment, no questions asked. But then once they start asking questions, they're stopping payment moving forward. So that's where they're coming up with that 400 million number. So just a brief summary of what employees should be on the lookout for and what they should do when they come across these fraudulent claims, which I'm sure you've all have a lot of examples of this. But if you're receiving one of those state issue questionnaires, it might be for an employee who still works there, an employee who has never worked there. On the claim, there might be missing information or incorrect information. Anything, we've seen it, an employee's first name might be missing and it's actually using their middle name and last name. The name might be misspelled, an address might be misspelled. If there's any fishy information like that on those questionnaires, it's a good indicator that it's probably from a fraudulent claim. And what you can do, you initially were saying, go ahead and fill out that questionnaire and send it back to the state just like you would with any other unemployment claim. Well, that can be really difficult to do if it was an employee who never worked there, if it was an employee who worked there 10 years ago. Filling out that form is difficult because they're only asking for pay data in the past 18 months for that employee. So instead of immediately filling out that questionnaire, you can actually go to report the suspected fraudulent claim online. And I pulled this up. So this link will take you to this page where you as an employer can actually report that identity theft. There's a form that you can fill out, and they just suggest that you use as much detail as possible when you're completing that. And primarily they want you to do, what they want you to do is contact the employee because they're the real victim who's experiencing identity theft. And there's a lot of things that they can personally do to protect themselves from this fraud, that's this fraudulent attack. And we'll get into suggestions for employees in just a few seconds here, because you're the employer. They're going to come to you and ask you what to do. So you're supposed to have the answers for them. And I hope I can give you a good couple of answers for them. A couple other things that you might see is if you receive a second questionnaire for the same employee, at that point, the state is saying it might actually be a true unemployment claim. So that first one might be fraudulent. If after they've done their own investigation and they issue a second questionnaire to you, then go ahead and pursue that as though it were a true unemployment claim. So I will go ahead and jump into what employees should be doing. So what you can tell individuals who are working for you, how they can fight this. The first thing to do is to report the theft on Colorado Department of Labor. So that's CDLE, I'm an individual reporting identity. Fill out all of that information as soon as possible and submit it. The next thing they're suggesting that you do is if you've received one of those Reliant cards, one of those pay cards that they are issuing the unemployment wages on, deactivate it. They're US bank cards, so contact US Bank directly. There's a link to a form that you can use. Deactivate that account before any wages can be removed from that account or any additional funds can be issued to that account. The next thing that you're going to want them to do is contact the 3 credit bureaus, Equifax, Experian, and TransUnion. I know I have phone numbers provided here, but what I've actually heard is because of all of the sheer number of employees who are needing to contact them, they suggest that you fill out an online form for each of those credit bureaus instead. And that is the quickest way to get a freeze, or what they're calling like an integrity hold, on your account if you've been notified. And then the fourth thing is just to create a file of any suspicious spending that you're seeing and any information and any action that you have personally taken to protect your identity at this point. The state unemployment actually created a new portal, or they've upgraded their portal, and it's My UI Plus, and it's just a plus sign. So any employee in the state of Colorado can actually go on and view any unemployment claims that have been made and any of their unemployment history. So that is a good place for them to go and monitor their history and to see if they've been a victim of this fraudulent claim, even if they haven't been notified. They're also suggesting that purchase identity theft protection. It's worth it right now with all of this that's going on. And then there's also another category of victims here, and it's those people who need that state unemployment. So if you are actually applying for that state unemployment wage, you can't get it right now because or it's very difficult to get it, or they might start and stop payments because of this investigation. A suggestion that was made, they partnered with a company called ID.me, so ID.me, and it's a website where you can go as an individual and actually register and verify your claim, your identity and your claim for that unemployment. And 85% of individuals who are truly in need of state unemployment, they are able to verify their identity and get the state unemployment that they need. I did see some questions come through while I was talking, and I apologize for running over a bit. Let's see if there's anything I need to address. Oh, Ronnie says they're actually not sending out questionnaires anymore. See, this is one of those things, it's just a moving target. This CDLE, that task force, is doing as much as they can to mitigate and create policies around preventing this from continuing to happen. So that is great to know. 7 days to respond. That's excellent too. Thank you, Becky. All right, those were the comments that I had. Again, this is going to be recorded. If you have any questions, I'm happy to point you to some excellent resources. So thank you all for joining us. Again, this is just our WRPA monthly meeting. If you're interested in being a part of this educational organization, we're happy to have you. I will send out a registration form when I send out the recording and the PowerPoint as well. So thank you all for joining us.
Yes, thanks everyone. Have a great day.
Thanks,
Thanks.
everyone.